Good morning and welcome to the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. Here are the stories we're following today. Joining us is Ecaterina Bigos, CIO for Asia ex-Japan Core Investments at AXA Investment Partners. Ecaterina joins us from our studios in Hong Kong. Thanks for making time for us. Can we talk about the elephant in the room, which is the re-election of Donald Trump? What do you think this means for markets across the Asia Pacific?
Look, I think with the winning of Donald Trump, we suddenly moved from, we switched from political uncertainty to policy uncertainty. And we all know that part of his campaign, he reiterated multiple times that he would like to change some of the economic policies, places like migration, tariffs, fiscal easing, and deregulation. So certainly, until he gets into the office, the biggest question is what scale will these measures take, and certainly what are going to be the implications. So certainly, market is pricing in some element of risk and some element of benefits from those measures that potentially will be implemented.
If you look at the price action of the bond market, I think the long end of the curve is very concerned about the inflationary impact of some of these policies. That may constrain the Fed a little bit. What do higher interest rates, or let's assume for a moment that the Fed can be less aggressive in lowering rates, what does that mean for you?
Indeed, I think this is a key risk. If you look at the ability of Fed to normalize monetary policies anchored around inflation. So with Trump coming into, again, as a president in 2025, with the measures that he potentially will put in place, primarily fiscal easing and the tariffs could be inflationary. What does it mean for the Fed is the ability for them to normalize monetary policy in 2025 will probably be a lot more gradual, if not at pause. I've seen some market participants even voicing potential risks of even hiking in 2025. Look, I think a hike will take a lot of a shock on the kind of the supply side for it to materialize. But it will depend, again, ultimately on the scale in which those measures are getting implemented.
Let's talk a little bit about the Asia Pacific specifically, and I want to begin with China. We had some very disappointing inflation data over the weekend. Not really a surprise if you've been tracking what's been going on with the economy. We do have a rollout of a little bit more economic stimulus. Perhaps the focus is more on what's happening with the refinancing of local government. There doesn't seem to be a lot of clarity here when you look at trying to directly boost domestic demand. And I'm wondering whether or not markets are going to begin to express a great deal of disappointment here.
There is an element of that, and certainly the markets have not taken the outcome of those policy measures quite positively. And I would say the policymakers are probably looking at the longer-term rebalancing of the economy rather than pleasing markets necessarily for short-term. The important what we need to observe is certainly there's a policy pivot and desire for the policymakers to do a lot more for the economy. We need to be cognizant that rebalancing the economy, course-correcting the economy to being a lot more consumption-driven and away from manufacturing, it takes time. And I would say the policymakers are probably applying a lot more gradualism than rushing in with certain measures that, again, they don't know the impact of. So I would say take the measures, see the impact, and then put in place additional measures.
Well, a moment ago, we were just talking about the potential for new tariffs from the U.S. Is China at a particularly vulnerable moment right now where new U.S. tariffs, higher tariffs, could potentially hit the export sector in a very damaging way?
I think there is definitely an expectation of that, but I think we need to look at the broader picture in terms of what are the tariffs that have been voiced by the potentially incoming administration. They talked about 10% broad tariffs across different partners and 60% to China. Yes, by kind of the magnitude by the scale of it, it seems that China will be the one that to suffer the most. But if you look at the biggest partners for U.S., Canada and Mexico actually have a bigger share of exports into China. And from 2016, when the first tariffs were implemented, to now, the percentage of imports from China or U.S. importing from China has decreased from about 9% to about 3% of GDP, of China's GDP. So certainly, yes, it's going to be impacted, but the scale and where the China is in terms of the ability to deal with that is probably changed to what it was in 2016.
One of the consequences of the pandemic was a diversification of supply chains away from China. So you have companies setting up facilities in places like Vietnam or ASEAN or India. Is this something that's going to get renewed acceleration because of the concern about maybe a more aggressive trade policy on the part of an incoming Trump administration?
Yes, and this is an observation that we made throughout, the last, I would say, 5 years. But I think as we go on, we've seen various reports to look at what is the basket of import, U.S. import from China. And I think the beneficiaries from that, of redirecting some of those trades, places like Vietnam, places like Thailand, Poland and Mexico potentially, will be the potential beneficiaries because they represent, or the exports that they have to the U.S. are similar to what China currently exports to the U.S. So certainly there are some exporters that are clearly identified at the moment. But as I said, ultimately, what comes next will depend on how China reacts as well, what they do on the back of those trade measures.
So we've talked a little bit about the wins that are taking place right now. How is that translating into an investment strategy for you?
In terms of our investment strategy, I think broadly it hasn't shifted a lot. What we have incorporated, a lot of bigger risk, as you said, on the rates element of it. We are constructive on carry assets or credit assets. The yields are attractive. And the credit, as you've seen as a part of the winning outcome for the Trump administration, credit spreads have tightened, and they're expected to do, credit is expected to do well in this kind of pro-growth measures that Trump is looking to put in place. Now, the biggest risk is still, as I said, rates, and we need to look at diminishing that risk or hedging that risk. Places and parts like equity, we stayed constructive on themes, technology, automation, which we do think will stay constructive during Trump administration. Places that potentially newcomers and reacted positively to that shift in narrative. We've seen financials reacting positively because, again, their expectations of increased deregulation. So there are some themes that stay, and there are some that we are monitoring increasingly.
Are you worried as well about how a weak Europe will drag on Asia? I mean, that's a very important market for many Asian exporters, is it not?
The Europe, I would say, it's certainly the challenge for not so much for China. I mean, I think percentage-wise, I think if you look at Europe, the 60% of companies' revenues are derived from global. So the resilience of the U.S. it's quite important for European corporate sector. What does it mean? Is if U.S. stays resilient and Eurozone is able to still conduct, exports to the U.S., I think is a positive. Tariffs is a consideration, and we need to reassess that, of course, when those measures come in place. So again, the calibration of that will come when the measures are exactly given to us.
So with a slow China and perhaps the perception, at least in the oil market, that an incoming Trump administration will do more to allow the industry to put more crude oil on the market, would you be concerned about going long some of the big commodities right now?
I think that for us, I think what we're looking, as a house, we're very much looking at deploying investment in places that allow for decarbonization of the world, right? And I think this is a key. And trajectory of decarbonization is going to continue. Whatever Trump administration comes and changes or amends some elements of the Inflation Reduction Act, which looked at energy independence and energy transition for U.S., that's a question that we need to assess later on. The trajectory for other countries, places like India, places like China, Europe, that trajectory doesn't change. So we have to look and aggregate. Again, the U.S. is important, but we have to look and aggregate. What is the trajectory of travel for renewable energy? And this is where we think this is going to be a growth theme that is going to stay for the next decade.
So does an incoming Trump administration do more to elevate geopolitical risk, or does it take some of the tension that has been unfolding recently? I'm thinking the Mideast, I'm thinking Ukraine. Does it reduce some of that pressure?
Well, we'll have to see. I do think there's, as we said, from the election uncertainty, we move to a policy uncertainty until the cabinet comes into the seat and we can see what measures are getting put in place. We don't know if this is going to conduct to an escalation or de-escalation. I think we'll just have to wait and see on this one.
Ecaterina, thank you so much for making time to chat with us. Ecaterina Bigos from AXA Investment Managers joining us here on the Daybreak Asia podcast. Joining us now is Brad Bernstein. He is Managing Director at UBS Private Wealth Management, joining us from Philadelphia. Thanks for making time to chat with us, Brad. Can we start with the results of the election? And I'd like to get your view on what you think Trump's win means for markets.
It means a lot. It means a lot because First off, just the fact that we don't have a contested election, we remove that risk, and that was a big concern for many participants. We moved the blue sweep risk, which would have meant risk off for markets with the potential for increases of cap gains next year, the potential for the very unpopular tax on unrealized gains, and even the quadrupling of the stock buyback tax from 1% to 4%. So by Trump having a clear victory, we removed all these risks, which we've seen markets really, enjoy the last few days.
So when I hear what you're saying, I'm thinking of the equity trade, and I'm wondering about the bond market because since the election, we've seen market rates kind of back up just a bit. It seems like there's a lot of concern among bond traders that a higher deficit is a distinct possibility, and we may end up getting a lot more in the way of new supply as well. Does that concern you at all?
Absolutely. So what we've seen really in the last 5 weeks leading up to the election is we saw the backup in yields as it really appeared that there was a pricing in of a red sweep in markets for the last month. And we've seen it in not only the bond market, but we've seen it across many, many different indices. The 10-year, which was the index most of us like to use as a gauge, was as low as 365, 375 about 5 weeks ago. And as this trade unfolded over the last 5 weeks, it ran up to an intraday high on Wednesday after the victory of around 445. And what we've seen since that day, Thursday, Friday, with the Fed cutting Thursday, is that dropped back about 15 bips. So we've seen that pare back a little bit as Treasuries came back on Thursday and Friday. So it is concerning. And, obviously we can get into why that's happened and the move and the volatility in the bond market.
So let's unpack that. How much of that do you think is due to this idea that tariffs are in the pipeline?
I think that's part of it. I think there's that aspect. I think there's the aspect that the markets have been pricing in more of a pro-growth agenda. And obviously, we still don't know the outcome of the House, but it appears to be going red. And with the pickup of the House, there'll be a Republican sweep as the market had been predicting, apparently, for the last 5 weeks with the way it's been pricing in. And what does that mean? That means is that the Trump administration in the first year will probably try to extend the Trump tax cuts that expire at the end of 2025. That being said, that adds potentially a lot more debt to pay for the Trump tax cuts, which is part of the thinking why we've seen a real backup in yields. So it's tariffs. It's the extension of the Trump tax cuts, which adds more debt, which means more issuance, which means more higher yields, as well as more pro-growth.
Well, how can we have pro-growth in the face of higher yields? Wouldn't those higher rates restrain growth to some extent?
It certainly may. I mean, but the one aspect of higher yields is that the Fed, wants to continue to cut the short end, which is where a lot of companies borrow. So a lot of companies are borrowing on floating rates, specifically smaller size companies, or about half their debt is floating rate. So that's actually very, very surgically beneficial to those companies. So yes, market rates have backed up. That hurts aspects of the lending market, such as mortgages, but there's aspects that are still improving as the Fed's cutting, as opposed for the floating rate type debt.
So I want to go back to where we started, which seemed to be your optimism around the equity trade here. Are there pockets of the equity market, given everything that you know about what the Trump administration may end up doing, are there pockets of the stock market that you favor right now?
There are. We actually like areas that actually were the best place to be this week. What did we see? We saw small caps perform. The Russell 2000 was up about 9% this past week, compared to the S&P, which is 4.5%. We really like small cap because from a valuation perspective, it's less than half that of large cap, which is not cheap. It's more sensitive to the Fed cutting rates because, as I just mentioned, about half the debt on the balance sheets of small cap companies is floating rate. And it also benefits from the Trump administration's protection of trade policies because most companies that are smaller are more domestically oriented, as well as beneficiaries from deregulation, which is inevitably going to be part of his administration. When you look at the composition of small cap, about 40% are regional banks, a very large exposure. and they're very impacted by deregulation as well as a steepening yield curve. Also, in terms of pure sectors, we love technology, specifically beneficiaries of AI. We just upped our growth forecast for technology for this year and next year. We love semis and large cap tech. As I just mentioned about regionals, we like financials a lot because I think they're a big winner with deregulation. And we're going to see a big comeback of M&A next year. There's a huge pent-up demand. So those are areas we really like. And actually, we think fixed income here is attractive. We've had this huge, very large backup of yields that we were just talking about, and we think it's still a great opportunity to be locking in some of these yields within fixed income.
So are you inclined to avoid offshore markets right now? And if that answer is yes, then I'm wondering whether or not your focus on the U.S. expands a little bit and it's more North America. Maybe you get a little bit of Canada in there. Maybe you get a little bit of Mexico in there as well.
Sure. I think we prefer in our own clients' portfolios to be globally diversified, but with a big overweight within the U.S. market. There are areas around the world that look attractive. India is doing extremely well. There's the hope that there's a lot of potential because if you look at valuations, international is much cheaper as well than the U.S. But U.S. has been the best place to be for the last, I'd say, 5 years or so. We definitely think long term you got to have that international exposure, but right now I think U.S. is the best place to be.
How are you feeling about crypto assets? It was Friday of last week that Bitcoin cracked above 80 grand for the first time. The perception here is that President-elect Trump will give a lot of support for digital assets. Is Bitcoin, let's say, or any other cryptocurrency a place that you have to have some exposure to at this point?
So we're not allowed to speak specifically to crypto assets, but it's been certainly part of the Trump trade that we've seen in the last few weeks. If you look at what the prices have done, there's been enormous speculation in a lot of areas in the market, and that has been an area that's gotten some of the best performance. But we're unfortunately not allowed to speak to the crypto market at this point.
Maybe you can speak a little bit to volatility. Is this going to be kind of a straight move up and to the right in terms of the equity trade? Is that your expectation, or is there going to be a little chop in the water here as we try to extend record highs?
I think into the end of the year, it's going to be pretty much a straight move up. I definitely expect to see a lot more volatility in 25 as the administration comes into office, and there'll be volatility around tariff policy and the ability for him to do what he's wanted to do and what markets have been pricing in. That being said, I think into the end of the year, things look really good because we have removed a lot of risks off the table into the end of the year. There's an enormous amount of cash. There's a lot of reasons to be in the market, and what investors are seeing is that the Fed is going to continue to cut rates and their return on their cash is going to keep dropping. And we've never had more cash than we do today in money markets with over $7 trillion.
Yeah, you anticipated my next question. So to clients, private wealth clients over at UBS, fully invested, whether it's equities or fixed income, you don't want anything that is in kind of a cash-like instrument.
Well, you got to have cash for your liquidity. But you don't want to have excess cash because it's not, cash has never been an investment. It's been, you have to have it and you have to have a certain amount in it. But what we've been doing, especially last week, was we've had many clients that have been layering into markets, and we've decided, for the next few months, we'd rather be invested. We want to be layering into markets right now. We want to get our capital invested. And I think the odds are stacked very favorably for equity markets into the end of the year. So money that you're layering in, get it in.
Brad, we'll leave it there. Thanks so much for making time to chat with us. Brad Bernstein, Managing Director at UBS Private Wealth Management, joining us here on the Daybreak Asia podcast. This is Bloomberg Daybreak Asia, your morning brief on the stories making news from Hong Kong to Singapore and Wall Street. Look for us on your podcast feed every day on Apple, Spotify, and anywhere else you get your podcast. Our flagship New York station is also available on your Amazon Alexa devices. Just say, Alexa, play Bloomberg 1130. Plus, listen coast to coast on the Bloomberg Business app, Sirius XM, the iHeartRadio app, and on Bloomberg.com. I'm Doug Krisner. Join us again tomorrow for all the news you need to start your day right here on Bloomberg Daybreak Asia.